Buying a home is one of the biggest financial decisions you'll make in your lifetime. And as firefighters, there are some things that make this unique. Today, I'm breaking down the simplest approach to buying a home, what actually matters, and what to watch out for. The biggest mistake people make is buying at the top end of what the bank approves them for. The top end is what benefits the bank. It's not what benefits your financial stability in the future. A good rule is this: the mortgage, the interest, the taxes, the insurance, and your HOA should fit comfortably in your budget without having to rely on overtime to survive. The numbers of this are anywhere from maxing out around 30% of your gross income should be the top end of what you're spending on for all of those things. Let's use a real example. So you bought a home in Folsom and the home price is $750,000. You put 20% down and you have a loan now for $600,000 on that house. A 6% interest rate makes that mortgage payment about $3,600 a month. But if the rates go up by even 0.5%, you end up paying an additional $200 a month in interest on top of it. So instead of being $3,600 a month, and now it's $3,800 a month. So $200 a month may not sound like a whole lot for your mortgage payment, but it does make a difference on your disposable income. And it actually ends up being about $70,000 over the entire length of that loan. Here's something most people never look at when actually buying a home. That interest rate on top of what you're paying for your mortgage ends up bringing it up significantly. So if the example we use of $600,000 for a loan, you end up paying $1.2 to $1.3 million in interest over the entire 30-year period of that loan. So even though the price of that home was $750,000, you're paying almost double that after the entire loan has been paid off. Here's another thing to think about. Most folks don't stay in a home for that entire 30 years. The average is around 8 years for either buying a new home or refinancing the current loan that you have. Because banks set up loans to benefit themselves, and because people stay in their homes for only 8 years before refinancing, most of these loans are set up in a way that the majority of the interest is paid in the first few years of buying it. So if you're buying at the top end of your price range for what the bank allows you to buy, or you're going to be selling or moving within that certain period of time like most folks typically do, you're paying interest every single time and you're not actually building the equity in that. That's why it's so much more important to stay in a comfortable spot for that monthly payment so that you can afford to pay that and maybe even have a little more to be able to pay the equity down on that so your amount of loan decreases. Paying down principal builds equity, and equity allows you to have more options for either refinancing or a better option for a home later. A simple smart buying principle is also this: don't buy the most expensive house in the neighborhood. The higher priced homes tend to raise the lower priced ones, not the other way around. Buying a well-kept home in the middle price range of that neighborhood allows you to be protected when the market dips and allow your house to appreciate as all those other values go up. Make sure you look at insurance rates ahead of time before buying something. Insurance rates in an area, suburban area like Folsom, run from anywhere from $150 a month, depending on what you're able to shop for. But if you're looking at more rural areas or higher fire risk areas, some of those insurances can be up to $500 or even $1,000 a month for insurance. If you're looking for property on the outskirts or in the hills, make sure that you check out the insurance, right? Because this will completely affect what you can afford monthly on this. Don't skip this step. Mortgages are front loaded with interest. So in the early years, the majority of that payment is going towards interest, not towards principal. This is why making early payments, even small ones, can have a huge impact on the entire amount of interest you pay and the amount of equity that you're building on your home early in your career. One extra payment a year can cut off to 4 or 5 years off of a 30-year mortgage. If you get strike team payouts, if you get cash leave paybacks from your department, or you have any kind of tax returns, getting big chunks of money like this and putting it towards your principal early will make a huge impact on that loan. Paying off your house early should not affect your retirement savings, and it should not affect your emergency savings. But if you're able to pay this off early and you can afford to do so because you've kept that payment reasonable for yourself, it's going to make a huge impact on your long-term financial stability. Your commute matters, your fatigue matters, school boundaries matter. Don't lock yourself into a home that works against you or your family. Buying a home should support your life, not strain it. Understand your numbers, stay patient, and don't let pressure push you in your direction. That'll hurt those things. Download the Home Buying Quick Guide in the description below. Thanks for joining me on Finance for Firefighters. Thumbs up if you like it, comments below. Hope you guys have a good shift. I'll see you in the next one.